So you've decided to sell the business you've poured your heart and soul into. What a moment, right? But hold on a second. Before you pop the champagne, there's a really important question you've got to ask. What's the tax bill going to look like? Well, you're in the right place. In this breakdown, brought to you by the experts at ProTax Accountant, we're going to get into exactly what UK taxes you need to have on your radar.
I mean, think about it. All those years of blood, sweat, and tears. Building something from literally nothing. The late nights, the risks you took, that constant drive, it's all been leading up to this moment, hasn't it? The moment you finally get to sell up and, reap the rewards for all that insane hard work.
And maybe, just maybe, that reward looks a little something like this. A cool £1,000,000. I mean, that's not just a number, is it? That's your success, right there. It's freedom, it's your future, all wrapped up in one big, beautiful figure. It's everything you've worked for. Genuinely life-changing stuff. But, and there's always a but, isn't there? Just as you're about to pop those champagne corks, that one little question pops into your head. After all the handshakes and the signed contracts, how much of that dream number do you actually get to walk away with? Because let's be honest, we all know HMRC is waiting in the wings for its slice of the pie.
All right, so here's what we've got on the cards. We'll kick off with the basics of selling, then dive into the big one, capital gains tax. After that, I'll let you in on a little secret weapon called BADR. We'll also look at some of the trickier parts of a deal, run through the key numbers you need to know, and wrap up with why getting the right advice is so important.
Okay, let's jump right in. Section 1, Selling Your Business, an introduction from ProTax Accountant. Look, selling your business, it's not just another day at the office, is it? It's a massive life event, a huge milestone. And to really celebrate that success, you've got to be prepared. Because if you don't have a solid grasp of the tax side of things, a huge chunk of your hard-earned cash could just vanish, straight to the tax man. And that dream payday can quickly turn into a really, really expensive lesson. And that brings us neatly to the biggest hurdle you're going to face. Let's talk about capital gains tax. This is really the main event, the number one tax you need to wrap your head around. Okay, to make this all a bit more real, let's talk about someone. Let's call him James. So James is a tech founder up in Manchester, right? And he's just sold his software company for a brilliant £800,000. Awesome! His first thought is, naturally, let's celebrate. But his second thought? Well, that really ought to be about tax. He's about to get a crash course in capital gains tax, so let's see how it plays out for him. So what on earth is capital gains tax, or CGT, as you'll hear it called? It's actually pretty simple in theory. It's just a tax on the profit you make when you sell something, an asset that's increased in value. So in James's case, the asset is his shares in the company. And the gain, well, that's just the profit, the difference between the $800,000 he sold them for and whatever they cost him to begin with. So let's crunch some numbers for James, shall we? For the 2025 to 26 tax year, if you're a basic rate taxpayer, you're looking at an 18% rate on business assets. But for higher or additional rate taxpayers, that jumps to 24%. Now, with a gain of $800,000, James is definitely in that higher bracket. So 24% of $800,000, well, that works out to a whopping $192,000 in tax. Ouch, that is a serious chunk of change to hand over. But wait a second. Don't panic just yet. That's not the end of the story for James, and it doesn't have to be for you either. This is where we bring in the cavalry, your secret weapon for absolutely slashing that tax bill. It's called Business Asset Disposal Relief. So what is this magic thing? Business Asset Disposal Relief, or BADR for short, is honestly a total game changer for entrepreneurs. Think of it as a special thank you from the tax man, a reward for all the risk and hard work you've put in, designed specifically to cut your capital gains tax bill, and cut it by a lot. And here is where it gets really good. Just look at the difference. Without this relief, James is staring down the barrel of a 24% tax rate. But with BADR, that plummets down to just 14%. Let's put that back into pounds and pence for James. On his £800,000 gain, that's the difference between a tax bill of £192,000 and one of £112,000. That is an £80,000 saving, right back in his pocket just by qualifying for this relief. Now you can see why we're calling it a secret weapon. Okay, here's a massive pro tip, and you're going to want to listen closely to this. Time is of the essence here. The current BADR rate is 14%, but that is set to increase to 18% from the 6th of April 2026. This isn't just a small tweak, it's a significant jump. So if you're thinking of selling, the timing could make a huge difference to your final tax bill. Acting sooner rather than later might be a very smart move.
All right, so how do you get your hands on this amazing relief? Well, you've got to tick a few boxes. First, you need to own at least 5% of the company. That means 5% of the shares and the voting rights. Second, you have to actually work there, as an employee or a director. Third, and this one is super important, you must have met both of those conditions for at least 2 full years right up to the day you sell. And finally, keep in mind there's a cap. BADR only applies to the first £1 million of gains over your entire lifetime.
Okay, moving on. Now, while BADR is absolutely fantastic, it's really important to understand that business sales aren't always straightforward. The structure of the deal itself can get pretty complicated, and frankly, this is where a lot of people trip up. So stay with me here. The next point might actually surprise you. So let me paint you a picture. The buyer loves your business, they agree on the price, but there's a catch. They want to pay you, say, 70% now, and the final 30% over the next couple of years, but only if the business hits certain performance targets. This is super common in deals. It's called an earnout. The big question is, how on earth does that mess with your tax calculations? Right. When that future payment isn't a guaranteed fixed number, HMRC has a lovely bit of jargon for it, unascertainable consideration. Basically, it means we don't know the final amount yet. So think about it like this. On the day you sell, you don't just get a lump of cash. You also get a promise of more cash later. That promise, that legal right to future income, is actually an asset in its own right. The fancy legal term is a chose in action. And it's so important to get this because that right gets taxed. And this is where things get really tricky. If the future payment is a fixed, known amount, ascertainable, it's simple. You pay tax on the whole lot in the year you sell. But if it's unascertainable, like our earnout example, you can actually get hit with 2 separate tax bills. Yes, you heard that right. First, you pay capital gains tax on the cash you get up front, plus the estimated value of your right to that future money. Then, a few years down the line, when you actually get the earnout payment, you could have to pay capital gains tax again on that cash. It's a massive trap for the unwary.
Which brings me to another absolutely critical pro tip. So, how do you figure out the value of that right to future money? You can't just pluck a number out of thin air. This is exactly why getting a proper professional business valuation isn't just a nice to have, it is non-negotiable. It's not just about setting the sale price. It's your evidence, your defense, for how you calculated your tax bill when HMRC inevitably asks questions.
Phew, okay, that was a lot to take in, I know. So let's just pause for a second and boil it all down to the key numbers you absolutely need to remember for the 2025/26 tax year. Right, think of this as your cheat sheet. The standard higher rate for capital gains tax is 24%. That's the rate if you don't get any relief. But your secret weapon, business asset disposal relief, or BAD, brings that rate all the way down to 14%. Just be aware, that rate is going up to 18% in April 2026. Remember, that amazing relief only applies on up to £1 million of gains in your lifetime, and to get it, you need to meet the conditions for that minimum 2-year holding period.
So now you know the numbers and the rules. That's a huge first step. But the most important part, applying all of this to your business, your sale, your life. So let's talk about making sure you plan your exit the right way.
Okay, and before we wrap up, I have to say this, and it's really, really important. Everything we've talked about today is for general guidance. It's designed to give you a great overview, but it is not official advice. Tax is incredibly complex, and everyone's situation is different. Please do not rely only on this to make major financial decisions. So what's the bottom line? To navigate this whole process properly, and to make sure you keep as much of your hard-earned money as possible, you absolutely must speak to a qualified expert. To really plan your exit the right way, and to talk through any of the things we've covered today, the best thing you can do is contact the specialists at Pro Tax Accountant. You can call or WhatsApp them on 07985689912, or just drop an email to info@protaxaccountant.co.uk. They'll know exactly how to help. Thanks so much for watching.